Hello and welcome to the show. I'm Puneet Wadhwa, and we have with us Mr. Rahul Singh, CIO of equities at Tata AMC with us. Hello and welcome. I'd like to start by asking you, how do you see the markets play out in 2024?
So markets are a reflection of the economy, and economy is going through a lot of positive changes in terms of the revival in the investment cycle. So being just driven by consumption, it is moving to driven by investment plus consumption. And I think that's a very good sign for sustaining the GDP growth rate and sustaining the multiples, which are not cheap, but they are not very expensive either. And we expect that the markets will remain reasonably strong and also broad, because most of the investment cycle revival beneficiaries are not just in large cap but in mid and small cap also. So we expect a reasonably steady to strong kind of a market, with markets being broad based across market cap categories.
Do you think that they'll see a downside first and then move up?
I think the timing of a lot of things globally is important for that to come out one way or the other. Obviously, I think elections are an event, but before that, we also need to take a call on in the US whether it's a hard landing, soft landing. When do the interest rates start coming down? Because today, what you are seeing is that there is FII selling primarily from the global emerging market funds, where the as the interest rates go high, you see redemptions from emerging markets. So if that starts to even out or smoothen out, you might see the markets becoming stronger, irrespective of the risk of elections. So the timing of a lot of these global changes in the interest rate cycle is what will drive whether it will go up first or go down first. At this point of time, all we can say is that the economy is looking good. The corporate balance sheet is looking good. The banking sector is in a good health, and RBI is very, very proactive in terms of controlling any major risk factors which they see. So, from a comparison perspective, India is looking very different in terms of what point of cycle they are in terms of the balance sheet and debt levels and the investment cycle revival versus the rest of the world and rest of the emerging markets, especially China.
Are the markets valuation in a comfortable zone?
So right now, I think the risk reward is slightly in favor of large caps. But as I mentioned, it's not that mid caps are very expensive. They are trading at 15-20% premium to large caps. Again, these are not very attractive levels, but these are not levels where I would get very worried either. So I would say that in the very short term, maybe the risk reward is more towards large cap. But if you look at the economy and the changes which have happened in the economy, mid and small cap where also the more opportunities will emerge over the next 3 to 5 year period, if the revival in manufacturing and the revival in the investment cycle sustains, which as at this point of time looks like there are very good driving forces for that to sustain.
So, what are the key risks for the markets in 2024, and to what extent are the markets discounting them at the current levels?
Well, the key risk for India always, apart from elections, which is difficult to call, has always been, crude prices and what happens to commodity price. Because end of the day, we are huge net importer of crude, and therefore anything which happens on crude prices, either because of geopolitics or any other risk, can become a huge risk for Indian macros, as well as for the profit growth estimates for the corporate sector, if it is also accompanied by increase in other commodity prices. So these are, I think, two India specific risks. As far as the other risk is concerned, it's mostly to do with equities in general globally. If there is a risk of event, if there are any global liquidity accidents because of the higher interest rates, then obviously India cannot escape that either.
Will 2024 belong to the debt and bond market investors as rates remain higher for longer?
I think the interesting part about equities is that the economy is going through a lot of changes. So right now it is a tussle between higher interest rates and good fundamentals. It remains very, very difficult to say with certainty whether that will be the case, the question you asked. But the good news is that there are a lot of good changes which are happening in the economy in terms of investment cycle revival, which sustains the GDP growth rate for much longer.
How do you see corporate profit growth play out in FY24 and FY25?
It is in the range of 13 to 15% both this year and next year. And as I mentioned, I think the fact that there is at various points of time either a margin support or a top line growth support. This year has been a lot of it has come from margins or margin improvement. Next year is where the top line growth should support that. So I would say the estimate should be in the range of 12 to 15% CAGR.
What's your take on flows into Indian equities?
So foreign flows are a function, as I mentioned, of the interest rates. Obviously, the GEM funds would be seeing redemptions at this point of time because of higher interest rates, and obviously India also will see outflows from that respect. But the India dedicated funds are seeing good positive inflows, like the domestic mutual funds. So I think as and when the overall macro in terms of the interest rate cycle reverses, you will see the FIIs gradually becoming net neutral and maybe net positive sometime later next year, in the second half of 2024.
What's your advice to an investor who wants to start constructing a portfolio now, let's say from a year's perspective?
Well, I would say that today we have to look at growth also and not just look at value, because economy is also going from a recovery phase to an expansion phase. So we cannot be 100% driven by just valuations. But if one were to be completely driven by valuations, then obviously, as I mentioned, large caps, including large cap banks and some of the other mega caps, is where I think the risk reward is slightly better than the other segments. Also, some of the sectors which have not done well for a fairly long period of time, like pharma, where things are turning around, is something which could make sense from a contra perspective.
Thank you for joining us today. We hope to see you soon, and have a great 2024.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.